Imagine waking up to find out the big win TikTok deal that was supposed to protect America might actually hand China even more leverage over your money, your data, and your portfolio. The market cheers, Oracle moons, politicians claim victory, and buried in the fine print is a risk that could smack U.S. investors in the face a few years from now. Welcome back to the comment section with Thomas Paul, where we read between the lines so you don't have to. And today we're talking about how the TikTok deal everyone's celebrating could secretly backfire on America, on tech, and on your portfolio. Let's start with why the market is so hyped. Stocks are ripping higher, and one of the sparks was this solution to the TikTok problem. Instead of a full ban, we get a deal. A nice, clean, everyone smiles for the camera deal. An American company helps secure TikTok's U.S. operations. Politicians get to say they were tough on China, and traders see a headline and slam the buy button. And here's where things get interesting. Because when everyone is cheering at the same time, politicians, big tech, and the stock market, you should probably check your wallet. The short version is this. Instead of actually cutting off China's control over TikTok, the deal basically tries to split the baby. The U.S. gets a kind of front-facing control partner, while the real crown jewel, TikTok's algorithm, its recommendation engine, and Beijing's leverage still sits on the Chinese side of the table. So the market says, crisis averted. But if you zoom out and look at the bigger picture, including data control, intellectual property, and long-term U.S.-China competition, what you actually see is America saying, okay, you can keep the brain of the app, just let us rent the body. Because nothing says national security strategy, like hoping the company that invented your problem will also help you solve it for a small consulting fee. Let's unpack what's really going on, what the key takeaways are, and then we'll talk about what investors need to watch before this comes back to bite us. First, the politics. This whole situation started as a national security conversation. Lawmakers in the U.S. looked at TikTok and said, wait, we've got a Chinese-owned app sitting on 170 million American phones, tracking behavior, attention, and possibly location and contacts. The parent company is in a country where the government can demand data on basically anyone at any time. That's not great. So the menu of options was ban it, force a sale, or negotiate some type of security partnership. A full ban would have been politically brutal. Millions of users, especially younger voters, would have lost their favorite app. Influencers would riot on Instagram stories. Brands would be furious. That's not a great look in an election year. A forced sale where a U.S. company buys all of TikTok's American operations, including the algorithm, would have been tough too. China has made it very clear that its tech algorithms and AI are considered sensitive exports. They don't want to just hand that over. That's their weapon. So instead, we get the compromise deal. On paper, it sounds like this. A U.S. tech giant steps in as a trusted partner for TikTok in America. They provide cloud infrastructure, data hosting, maybe some oversight on what happens to U.S. user data. Government officials can point and say, see, American company. Strong protections. You're safe. But wait, it gets even wilder. The piece that matters most, the actual recommendation algorithm that decides what you see, what goes viral, and how attention is shaped, is still ultimately coming out of China's ecosystem. That's like saying, don't worry, we're keeping the nuclear code safe, but we let the other guy design the launch system. This is the first key takeaway. This deal is way more cosmetic than structural. It reduces some obvious risks, like raw data streaming directly from U.S. servers to Chinese servers, but leaves intact the core strategic advantage, influence. Influence over what people watch, what ideas spread, what sentiment gets amplified. In a world where attention is power, that algorithm is the warhead. Second takeaway, this looks a lot like a quiet bailout packaged as a national security fix. Think about who gets saved here. TikTok obviously wins. It doesn't get banned in its most valuable advertising market. It gets to keep growing, keep harvesting data, keep owning youth attention in the U.S. The U.S. partner company wins. They get a major cloud customer, long-term revenue, and a shiny PR talking point. We're protecting America's data. Politicians win. They can go on camera and say, we stood up to China, without actually forcing a clean break. No users lose access, no major platform disappears, and they don't get blamed for killing the app your teenager is addicted to. And the market? The market absolutely loves this. Because from Wall Street's point of view, the worst-case headline, TikTok banned, tensions spike, tech sell-off gets replaced by deal reached, risk lowered, buy the dip. But here's the problem. Every time we paper over a structural conflict with a short-term deal, the long-term tension gets worse, not better. The third key takeaway, this deal confirms a pattern. China wants to keep its tech companies plugged into Western markets to access our consumers, our advertisers, our capital, while still keeping ultimate control on their side. They want the money and the influence, without the transparency or reciprocity. The U.S., meanwhile, keeps trying to draw a line that says, "We want your products, but we're scared of your power. Can you just be less scary, but also keep boosting our stock prices?" So we keep building these weird hybrids, partial bans, partial restrictions, joint ventures, review boards, oversight committees. Everyone acts surprised when these half measures don't magically eliminate risk. You won't believe what happens next. Investors start pricing in problem solved when the actual geopolitical fire is still burning underneath. That is the hidden risk here. If the market decides TikTok is safe now, China tech is back, political risk is over, we could see way more capital flowing back into names and sectors that are still totally exposed to future shocks. Because remember, none of the underlying structural issues have gone away. China still has laws that require companies to hand over data on request. There is no independent rule of law that overrides the state. The U.S. still sees Chinese control over core platforms as a security risk. And we're heading into a world where competition isn't just about gadgets and trade deficits. It's about AI, data, semiconductors, social media, and control of digital infrastructure. So when you look at this TikTok deal through an investor's lens, you should be thinking, is this a fix or is this a calm before the next policy storm? Let's talk about what to actually watch if you care about your portfolio and not just the headlines. First, pay attention to how temporary this solution feels. If you see language suggesting reviews, renewals, approval boards, or national security oversight that can be revisited, that's code for this could blow up again when the political winds shift. This means TikTok's U.S. fate could get reopened by the next administration, the next big scandal, or the next geopolitical incident. And if that happens, you'll see a repeat: tech volatility, regulatory fear, and another round of sudden de-risking in anything tied to China. Second, follow the escalation curve between the U.S. and China on other fronts: chips, AI, rare earths, export controls. If relations keep worsening in those areas, this deal becomes fragile. Third, watch what happens with other Chinese apps and platforms. If TikTok gets a deal and other Chinese companies start copying that model, we'll slap an American partner label on it and call it safe. We might be sleepwalking into a two-tier world where Chinese firms are deeply embedded in U.S. markets, but U.S. firms get much less access in China. That has big implications for valuations, margins, and where long-term growth actually gets captured. Now let's get more specific for investors. If you're holding U.S. cloud and infrastructure names, you might feel like this is pure upside. More workloads, more data hosted in the U.S., more contracts with high-profile customers. And yes, in the short term, that can absolutely be bullish. But don't ignore concentration risk. When a high-profile deal is driven by political pressure, it can be undone by political pressure. A lot of people forget this, but government-fueled hype can flip to government-fueled fear almost overnight. If there's ever a scandal involving TikTok content, data leaks, election interference, or anything that smells like state influence, this exact same deal that is being praised today will get dragged through hearings tomorrow. And the American partner? They don't get to walk away clean. They become part of the story. So one thing to watch is, how aggressively does the partner company try to define and limit their role? Are they just hosting data, or are they also vouching for security, algorithms, and compliance? The more they own the solution, the more they own the blame if something breaks. For tech investors, that's a hidden liability. Now let's zoom out to China-exposed equities more broadly. The market loves a de-escalation headline. Any sign that the U.S. is willing to do business instead of slam the door on China gets read as bullish for Chinese tech stocks, ADRs, and even multinational companies that depend on China for growth. The risk is that investors confuse a single tactical compromise with a strategic thaw. They're not the same. This TikTok deal is not a peace treaty. It's more like a ceasefire in one small corner of a much bigger war over data, chips, and technological dominance. If you're buying Chinese tech or U.S. companies heavily tied to Chinese supply chains purely because you think, hey, they worked out TikTok, everything's fine, you're not investing. You're gambling that politicians won't wake up on the wrong side of the bed. Here's where things get even more uncomfortable. From Beijing's point of view, this is a win. They keep control of the algorithm. They keep access to American users. They calm down a crisis without making a big concession. And they send a message to other Chinese firms. With the right political theater, you can keep one foot in the American market. From Washington's point of view, it's a short-term win. They avoid banning a wildly popular app. They get to look tough, and they can claim a solution that reassures voters and markets. But for long-term U.S. strategic power, this might be a slow-motion own goal. Why? Because it normalizes the idea that the U.S. will tolerate foreign-controlled platforms at the very center of its information ecosystem, as long as there's some kind of corporate Band-Aid on top. Instead of building and seriously backing domestic competitors or setting clear digital sovereignty rules, the U.S. is basically saying, we'll keep improvising. That's not a strategy, that's vibes. For a finance audience, here's the punchline. Vibes are great for trading days, terrible for capital allocation. If you're thinking 5, 10, 15 years out, you need to ask, where is the real power flowing? Who controls the rails of AI? Who sets the rules on data? Who actually owns the platforms where younger generations live online? In that world, this deal is a sign that China's long game is still working. They export platforms, capture attention, and keep meaningful control, while the U.S. keeps cheering for the stock price and crossing its fingers on security. So what should investors actually do with all of this? I'm not here to give you individualized investment advice, but I can tell you what to watch like a hawk. First, discount the headline euphoria. When you see giant candles up on any stock tied to this deal, ask yourself, is this a structural improvement or a sentiment sugar high? Huge opening volume and massive green candles can be more about relief and options activity than about real fundamental de-risking. Second, treat U.S.-China news as a volatility engine, not a one-way bet. You'll keep getting cycles of panic deal relief rally. The players change. TikTok, chips, tariffs, exports. But the pattern repeats. Smart money uses these swings instead of falling for the finely fixed narrative each time. Third, build a mental map of your portfolio's China exposure, not just through Chinese stocks, but through U.S. names that rely on Chinese users, Chinese supply chains, Chinese data, or Chinese platforms. Some U.S. tech companies are quietly becoming dependent on revenue streams and partnerships that sit on top of this geopolitical fault line. If that line cracks, you're not just looking at some PR headache. You're looking at real earnings risk. Fourth, keep an eye on regulation. If Congress, regulators, or security agencies start asking deeper questions like, who really controls the algorithm? Or what happens in an emergency? That's your sign that the political protection this deal gives is not permanent. If the narrative shifts from, we solved TikTok to, we need to revisit TikTok, you'll see it in price action before you see it in press conferences. And finally, don't underestimate the psychological angle. Younger generations are growing up on platforms that are, at minimum, influenced by foreign governments that do not share Western political values. That shapes future voters, future consumers, and future policy preferences. If you control the feed, you have leverage, not today, but over a decade, much more so. From a macro and market standpoint, it means we are monetizing our attention today in exchange for strategic dependency tomorrow. Great for quarterly earnings, less great for national bargaining power. To sum it up, the TikTok deal looks like a win for everyone in the short term. China keeps its crown jewel, the U.S. gets political cover, big tech gets a new revenue stream, and the market gets a rally. But under the surface, the core risk remains. Foreign control over data and influence in the U.S. stays intact, just with more layers of corporate theater in front of it. For investors, the trap is thinking, crisis over. The smarter take is, new chapter in the same story. Now I want to hear from you. Do you think this deal is a clever way to manage risk while keeping the market happy? Or is it a long-term strategic mistake that we're going to regret once the next crisis hits? Drop your hottest take in the comments. Is this a smart compromise, a quiet bailout, or the moment we basically admitted we're willing to rent out our attention to the highest bidder? If you got value out of this breakdown, hit like so the algorithm, whichever country it's loyal to, actually shows this to more people. And if you want more deep dives at the intersection of politics, tech, and money, subscribe to the comments section with Thomas Paul and turn on notifications. Because the next time a problem is solved in U.S. China tech, You're going to want to know what's really going on before you put your capital on the line. Thanks for watching, and I'll see you in the next one.